Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Friday, November 10, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Nothing happened today. It was a Friday. It's a Friday float. The market is typically quiet on Fridays, as we know. Obviously, there are exceptions to the rule, but today was no exception. It was relatively quiet. Not a lot happened. So, of course, there's not a lot of change from yesterday. When we look at the S&P 500 or the SPDR, for example, the SPX or the S&P 500 cash index was down $2.32. The SPDR was down 14 cents. It's not a big deal one way or the other. Yesterday, we pierced through the 20-period moving average, and the market fought its way back to have a pretty decent close. And today, we basically just had a flat day for the most part. Nothing happened one way or the other. So still, we have yet to see a crack in the S&P 500. As long as we're in this uptrend, and the trend is your friend until the very end, as long as we're in the uptrend above the moving averages, trending higher, that's what we're doing. We continue to grind higher. We'll have some sideways days. We'll obviously have some down days. But for the most part, there's nothing wrong with this market. Until there is, at some point in time, we will have a signal or a sign that there has been a change in the market. But right now, the market remains the same. There's no new information in the S&P 500 today. So we're just going to move it along and talk about the other markets. When we look at the IWM, we saw much of the same routine. Yesterday, we had a pretty decent down day and then a rally higher. We closed above the 50-period moving average. Today, we maintain that level, testing it, but closing above the 50-period moving average. Again, just like the S&P 500, it was for the most part a sideways day in the IWM. Not a big day on the upside, not a big day on the downside. It was a very narrow-ranging day, just like the S&P, and therefore nothing happened. There's no material change from yesterday. Now, with the IWM, certainly this market is not at new highs. This market doesn't look, or I should say the chart doesn't look the same as the S&P 500. The S&P is in a bullish uptrend above all the moving averages. The IWM is not above all the moving averages. It is in an uptrend when you look at the longer term chart, of course, but on the daily chart, there has been a little bit of damage done, and it would not be uncommon or out of the ordinary for us to see the IWM trade all the way down. It's not all the way, it's not that far away, but down to the 144 level, give or take. That's the level that I've had my eye set on. That's the target on the downside if we do have any more downside pressure in the IWM. I think that would present a very good buying opportunity down at the 144, 144 and a quarter, down at this level, filling this gap, and the official gap fill comes in at 144.61. So anywhere between 144 and 144.61, let's say, is an opportunity to buy the IWM. If it should continue down farther, the 100-period moving average, which is the purple upsloping trend line, today coming in at 143.20, that would also be supportive of the market. Other than that, there's no change. There's no change in my downside target, and there certainly wasn't any change in the market today as it relates to the IWM. The transports. Now, the transports did have a little bit of a down day today. Not a big one, down 16 points, but we closed pretty much right on top of the big fat round number of 9,500. 9,501 and change was the official close. We did not close below yesterday's low, so I can't really say it was a negative close, even though it looks like it was. We closed below the green candle low, which came in right where this trend line is, at 95.15 spot 93. But we're in the middle of this consolidation area, and like I said last night and several days before, coming down to the 93.83, the 200-period moving average, this gap fill down here, that would be an opportunity. That would be a good opportunity to buy the Dow Jones Transportation Average. But let me show you why at least from the longer term perspective, it wasn't as negative as it might look, because we closed below this green up candle. When you go over to the weekly chart, you'll see here that the actual weekly close that's important, the low comes in at 94.86 spot 86. Pardon me. Let me just read that one more time. The low is 94.86 spot 66. That's the low of this weekly candle. And then the next candle down, you have a gap window, and then you have the gap fill. That's the green trend line. So while it's a negative looking market, it wasn't all that negative of a close as it might look on the daily chart. We're still in the middle of this consolidation area, and I'll just point it out. This is a good consolidation area, but really my target is on the downside at 93.83 and change. So it's really the 200 period moving average. I think that presents an opportunity to buy the transports. Remember what we talked about last night. This was day number 21 since the pivot high. The pivot high all the way up here. Today was the 21st day down since that pivot high. That's generally an important number. You can make a case for a pseudo doji candle today. It was a very narrow ranging day. We didn't really get any kind of a significant trend change signal as far as I'm concerned, but that still doesn't preclude the market from going up next week. I just think this is an important time frame. I think we're due for a turn in the transports, so I won't be surprised if we see the market start higher early next week. If it doesn't, and we come down to the green trend line and the 200 period moving average, so be it. That also presents an opportunity to buy the transports. It's not that far away from where we are now in the big scheme of things. The gold market. Now, gold was down about $12 today, $11.90. So it was down almost 1%. And while we tried to break out yesterday, today we failed. And this is why I said there's no long trade, there's no short trade. We're in the middle of a range. Very difficult market to trade right now. We had what looked to be like a breakout occurring on the upside yesterday for the last couple of days. We got above the moving averages, and today the market failed, putting this bearish pattern back on the table. If we come back down to the 200 period moving average, this trend line here, and we close below that level, that tells me the likelihood is increasing, or the probabilities are increasing that gold is going to go down to the 1248 level. It's not going to happen all at one shot. There are support levels along the way that will get tested and will get bounced off of intraday at minimum. But that's what I think is occurring if we do get a close below the 200 period moving average. Right now comes in at 1269.70. Since it's Friday, we'll look at the weekly chart of gold, and you can see how we're trapped in between the 20-week and the 100-week moving average. And that's where we are, and that's why you're seeing gold bounce back and forth, back and forth. Apparently, the chart is telling us this is an important level. And look at the 50-period moving average and the 200-period moving average right below that. There's a lot of chart support in this general area. So it's not uncommon, and I'm not surprised that gold is finding it difficult to A, rally, or B, sell off. It's one of the reasons why it's kind of trapped where we are now. Going back to the daily chart, you can see we're in the middle of a range and we're trapped in an area. And when you see that, here's the range. Here's the bottom end of the range. Here's the top end of the range. Here's the middle of the range. And we're just trapped in the middle of the range until and unless gold picks a direction and gives us a defined and viable signal that it's going in one direction or another. The only thing we can do is leave it alone and let the charts tell us what the next likely scenario is for the yellow metal. Until and unless that happens, we just leave it alone. Cash is a position. Silver also came down today about 0.6%, and you can see we closed below the 100 period moving average. Now, silver is in a slightly different picture or position than gold is. We have two green up candles that we seem to be staying above. The first one is right here, so this is on a very short-term basis. You can see how we tested the low of that green candle today. And the second one is here. Until and unless these two levels are broken, then silver, technically speaking, on a short-term basis, is still in a bullish pattern developing. But if we break below the second level down here, this green candle low that comes in at 16.67, then we're going to go test some lower levels in silver. Until and unless that happens, technically we're in a bullish pattern. But again, same as gold, we're in the middle of a range and it's unclear. And when things are unclear, here's your range. When things are unclear, we don't do anything. You keep your money in your pocket until things clear up on the charts. Again, cash is a position. Crude oil, we continue to make a bullish pattern going sideways back and forth for the last several days. Nothing's changed from yesterday. I still think it's likely we come down to test the 55.92 level, but what it's doing is working off some of the overbought condition, eating some time off the clock, letting price either go sideways while the 20-period moving average moves up into price, or eventually price will come down towards the 20-period moving average. Either way, this is the chart's way. This is crude oil's way of working off some of the overbought condition, and what it's doing is it's setting up for another move higher. It's building energy by going sideways, setting up for another push higher, likely going to about the $59 area, maybe even as high as 60 and change. That's an area we're likely to be interested in shorting crude oil. So let it consolidate, let it pull back a little bit, let it build the energy it's building, let it build enough energy to get up to $59, $60, and that's where we'll evaluate a potential longer-term short trade in crude oil. Net, nothing's changed from yesterday in crude oil. The bond market, pretty good decline today in the bond market. Bonds were down 1%. We're at an interesting juncture in the bond market. Now, from this pivot low to the recent pivot high, and we know what the recent pivot high, we know why that was resistance, right? So you see the red candle, the breakdown candle, very high percentage of the time, that's going to be resistance to the market. We could have consolidated and pushed through, but here, instead, we're pulling back. Now, this could just be a pullback, and we could be setting up for higher prices. However, it's going to be make it or break it next week, because what we did today was from this pivot low to this pivot high, this is right about a 618 retracement where we stopped short today. So let's see if that was just all it was a retracement of the most recent up move. And if it was, we could take off to the upside. If we have a deeper retracement, we could still come down and test the 200-period moving average. But if that doesn't hold, then we come down to double bottom. And if that doesn't hold, we go lower. It's too early to tell. Right now, it could just be a garden variety pullback or retracement setting up for higher prices. We'll see what happens early next week. But one thing we do know, or we did know, is there was a high probability that this was going to be resistant to the market. It works over and over and over again. Nothing's 100% of the time. But when you see a breakdown candle and you have a market that goes up for several days in a row, nonstop, up into that breakdown candle, there's a high likelihood that the market is going to, at minimum, of pause at that breakdown candle. Either consolidate and setting up for another push higher, or be rejected at that breakdown candle and give you at least some kind of trade off that breakdown candle high. So that's just what happened here. We talked about it before it happened, and here it is after it happened. So we'll see what's in store for bonds next week. And by the way, again, and I always say this, but it has nothing to do with the bond market. This is just how charts work. It could have been any name on this chart. They all act and react the same way. Now, the dollar, we talked last night about the dollar coming into the 20-period moving average. Likely that was going to hold, and we'll see if that's the case next week, and if we take another shot higher out of this bullish consolidation pattern. So there's no change in the dollar, nothing of a revelation here. We have an up move, we have a bullish consolidation pattern. We lightly tested the 20-period moving average today, bounced off that. Is this going to promote another move higher? That's the likely story. We'll see what happens into next week. No revelation, nothing new. The market's doing exactly everything we discussed over the last several sessions. And with that, it's everything I wanted to discuss tonight. So I'll wrap it there. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.